Ed Yardeni is president at Yardeni Research. He's joining us now. Ed, good morning. Good to have you with us here. Thanks very much for your time. We have the Fed decision on Wednesday, and then we got the union budget, which is an important event in the calendar here. How should markets broadly behave in the near term? Ed, do you believe that there is a correction due in the U.S.? Things are stretched out there.
Well, I think things are stretched just in certain areas of the market. We had a really good rally in the small cap and mid cap stocks until recently, and then they suddenly underperformed, and the mega cap 8, the big ones, suddenly outperformed yet again. So I think that the large caps are somewhat stretched. We're going to get a lot of earnings this week from these large caps, and probably they're going to be surprisingly good. And I wouldn't be surprised if some investors sell on the good news.
Okay, but how are you positioned on the FOMC rate decision particularly? I mean, there's no rate cut expected this time around, but are you expecting any indication of when the loosening would start? And if yes, how do you think equity markets would react to that?
Well, it's a tough call because I could see it going either way. Unfortunately, I'd like to be more definitive. But I have to be realistic here. And what I see is a situation that if they come across as too dovish, indicating that they may start lowering interest rate in March because they're so pleased with the drop of inflation, then we could have what could be a NASDAQ melt-up, which then creates a whole other problem for the Fed. At the same time, another possible scenario is the Middle East blows up, which it seems to be doing right now. With oil prices going a lot higher, and suddenly we're looking at something like the 1970s. So I think the Fed would be wise to do nothing, just to leave interest rates where they are. The economy's strong, inflation's coming down, financial conditions have actually eased dramatically. So they don't have to lower the Fed funds rate to ease up on financial conditions. They're already very easy.
Hi, Ed. Good to see you in. Ed, 2 points for 2024. One would be, earlier you were talking about, I think, the S&P 500 heading towards 5,400 and then towards 6,000. Do you hold on to that thought?
Yes.
For this year, I think 5,400.
Yes,
and the second part is, what about the Fed? For 2024 on the whole, how many rate cuts are you pricing in?
Yeah, well, I sometimes can tend to be a bit of a contrarian when I see that everybody's sort of in the same camp. I don't really want to join that club. Too many people are looking at that, and the surprise could be the other way. And in the current situation, the market and most investors have been assuming that we're going to have 4, 5, 6 cuts this year. And I think a lot of that's based on the view that the economy is still going to go into some sort of mild recession. I think the economy's proven itself to be remarkably resilient. We saw that in third quarter real GDP being up over 3%. And by the way, it's probably going to be the third quarter in a row of very strong productivity. So in that scenario, I don't even know if we need any rate cuts, quite honestly, but 2 to 3 is possible.
And S&P heading to 5,400 by the end of the year, right?
5,400 by the end of this year, 6,000 by the end of next year. So fundamentally bullish. In the near term here, I'm somewhat concerned about what's going on with the Middle East, things getting worse.
Okay, things are getting worse in the Middle East, but you're quite confident about the U.S. economy. Got that. Thanks, Ed, for joining us and giving us a quick take on your views. Well,